There is a company trading right now that pays a 9% dividend, dominates its home market the way few businesses anywhere dominate theirs, and trades at around 7 times earnings. There is another one in a completely different industry that sits on net cash, owns some of the most valuable shopping malls in its country, and is expected to pay a dividend of around 7 to 8%. Both of these companies are profitable, both are growing, both are public, liquid enough to buy, and sitting in plain sight. So here is the question I want to start with. If artificial intelligence has really made markets perfectly efficient, if alpha is dead, if stock picking is a waste of time in 2026, then how do these two businesses exist at these prices? None of this is financial advice. I own positions in both companies, and I have published full analysis of both on my Patreon. What I want to do today is talk about why the fear that AI has killed investing is, in my opinion, completely misplaced, and use two names as evidence. Over the past couple of months, I have seen more and more investors, especially newer ones, convince themselves that the game is over. The argument goes something like this. Large language models can read every 10K in seconds. Hedge funds have armies of quants. Information is instant. Therefore, every mispricing gets arbitraged away the moment it appears. And there is no point in trying. I think that is completely wrong. And I think it is wrong for two structural reasons that have nothing to do with whether AI is impressive or not. First, markets are still made up of human beings. Human beings are emotional, impatient, biased, and mistake-prone. They chase what is working, panic when prices fall, anchor to recent narratives, and often confuse popularity with safety. Not everyone is Buffett. In fact, nobody is. AI does not remove the human element from markets. It just gives better tools to people who still bring the same psychology and the same weaknesses to the table. Second, markets are not efficient because everyone is smart. Markets are efficient when capital is both willing and able to move into mispricings and correct it. Where capital cannot move, prices do not correct, no matter how obvious the gap is. And even where it can move, prices can still stay wrong, because the people allocating the capital are still human. There is still a huge amount of capital in the world that cannot move into the kinds of names I am about to talk about. Not because the managers are stupid, but because they are too big. So, Warren Buffett owns Apple. Everyone knows this. And every time a beginner asks what they should buy, somebody points at Buffett and says, well, he owns Apple. So Apple must be a great investment. Here is the thing. Buffett owns Apple because he is managing hundreds of billions of dollars. At that size, his universe of possible investments is incredibly small. He literally cannot buy a small company without owning the entire thing, and even then, it would not be able to move the needle for Berkshire. So he is forced into the largest, most liquid names on earth. Apple, Coca-Cola, American Express, Bank of America. These are not the best businesses he could find. These are the best businesses he could find that are large enough for him to buy. If you handed Buffett only $1 million tomorrow and told him to start over, he would not touch Apple. He would not touch Visa or MasterCard. He has said this himself many times. He would be hunting in the corners of the market that nobody is looking at, the same way he did in the 1950s when he was running partnerships and finding obscure names trading below net cash. I am not saying you should be ashamed of owning Apple or Microsoft or Google. These are excellent businesses. What I am saying is this. If you want outstanding returns, you cannot just do what everybody else does and expect to outperform them. By definition, if you own what everybody else owns, you will get the same returns everybody else gets. And right now, what everyone else owns is the same handful of US large caps that every fund on earth is forced to hold. The opportunity has not disappeared. It has just moved to where the big money cannot follow. Now, I know what some of you are thinking. He is talking about a Turkish company and a Kazakh company. Of course he thinks they are cheap. Of course he likes them. But they are obviously much riskier than Apple. I want to address this honestly, because it is a fair concern. Yes, these businesses carry country risk. Yes, Turkey has currency volatility and Kazakhstan is a frontier market. I am not going to pretend these are the same as buying a US blue chip. But here is what I want you to think about. The lowest risk stocks in the world are mathematically doomed to deliver low returns. That is not pessimism. It is just how pricing works. If a business is universally agreed to be safe, it gets bid up until its expected return matches that safety. You cannot have it both ways. You cannot demand the safety of Apple and the returns of a small cap mispricing in the same investment. Risk and reward are linked, and the excess premium that small investors get for being able to fish in waters the whales cannot enter is real. But you have to be willing to take it. With that framing in mind, let me show you the two names. The first one is Torunlar GYO, ticker TRGYO on BIST. It is one of the largest publicly listed real estate investment companies in Turkey. The stock is at 88.4 liras, up about 50% over the past year, with a market cap of around 88 billion liras, which is roughly $2 billion. Torunlar owns a diversified real estate portfolio worth 162 billion liras as of the end of 2025. About half of that is shopping malls, with the rest split between offices, ongoing projects, completed units for sale, hotel, marina, land, and a meaningful cash position. The company has stated a dividend policy of paying out a minimum of 50% of distributable earnings, and it carries net cash on the balance sheet. That's equal to 35% of its market cap. Let me say that again, because in a country where interest rates have been north of 40%, this is unusual. Torunlar has zero loan to value. Net debt is negative 30.9 billion liras. This is a company sitting on a mountain of cash, not drowning in debt. Here is the operational picture for 2025. The portfolio is 97% occupied, with 3 of the 6 malls at 100% occupancy. This is not a struggling business. This is a portfolio of dominant retail assets in some of the most populated cities in Turkey. When you look at the income statement, you have to be a little careful, because Turkey uses inflation accounting, and the headline net profit number can be misleading. Reported net profit for 2025 was 7.7 billion liras, which actually looks down 31% from last year. But if you strip out the deferred tax expense, the monetary loss, and the fair value adjustments, the underlying net profit was 18.4 billion liras, up 23% from the prior year. So, the headline looks bad. The underlying assets are excellent. And this matters a lot for valuation, because if you actually use the real earnings number, the stock is not trading at 11.4 PE you see on Google Finance. On 18.4 billion liras of underlying net profit and a market cap of 8.4 billion liras, Torunlar is trading at roughly 4.8 times earnings. Less than 5 times earnings on a debt-free real estate company growing rents over 20%, with malls in some of the most populated cities in Turkey. This is exactly the kind of accounting confusion that creates mispricings, because most investors do not bother to read past the first line. And the screeners they rely on do not bother to adjust for inflation accounting either. The company also publishes a 5-year cash flow forecast. By 2030, on their own projections, Torunlar expects to be sitting on 88 billion liras of net cash, while paying growing dividends along the way. The dividend line is highlighted in green here, and you can see it growing meaningfully over the period. For 2025, the dividend has not yet been officially announced, but my expectation is that it will land somewhere between 6 to 7 liras per share. On a stock price of 88.4 liras, that is a yield of roughly 7 to 8%, and that is on a company trading at about 54% of its own stated net asset value, with zero debt, growing rents, and a clear capital return policy. So in short, the company will pay over half of its market cap in dividends over the coming 5 years, will have its market cap in net cash, and it will still be having a massive portfolio of rent-producing real estate. I want to be transparent. Again, I have a small position in Torunlar, and the full thesis, including how I think about the residential pipeline and the mall valuations, is in the deep dive on my Patreon. The second name is Kaspi, ticker KSPI on NASDAQ. The stock closed recently at $76.4 per share, down about 45% from its July 2024 high. Market cap is around $50 million. PE is around 7. For those who don't know Kaspi, this is the dominant payments, marketplace and fintech company in Kazakhstan. It is a super app the way WeChat is a super app in China. Almost everybody in the country uses it, and most of them use it every single day. I want to show you the kind of dominance we are talking about, because numbers like these are rare. When Kazakhs are asked which mobile apps are installed on their phones, 47% name Kaspi. The nearest competitor gets 8%. When asked which payment apps they know, 79% name Kaspi, against 6% for the nearest competitor. That is a 13 times gap. For e-commerce, Kaspi is at 44% versus 14%, for travel apps 54% versus 13%, for car buying 74% versus 8%. These are not the numbers of a company in trouble. These are the numbers of a business that has effectively become the default consumer financial and commerce layer of an entire country. Now, let us look at what this dominance produced in 2025. Consolidated revenue of 4.05 trillion tenge, which is $8 billion, up 60% year over year. Net income of 1.07 trillion tenge, which is about $2.1 billion, up just 1% year over year. That 1% number is exactly why the market has been punishing the stock. On the surface, it looks like the growth has stalled, but it has not. Look at what happened underneath. Here is the breakdown. The Kazakhstan business by itself generated 1.2 trillion tenge in net income in 2025, which is $2.3 billion. That is up from the prior year. The reason consolidated net income only grew by 1% is that the Turkey operations, which is Hepsiburada, lost 93 billion tenge, or about $200 million. So, the core business in Kazakhstan is doing exactly what it has always done, throwing off enormous profits. The headline number is being dragged down by a deliberate investment in Turkey. And here is the part the market seems to have missed. In the fiscal year 2025 results, CEO Mikhail Lomtadze stated very clearly that Hepsiburada will be managed to around adjusted EBITDA break-even in the near term. So, they are not committing to burn cash forever in Turkey. There is an additional $300 million investment planned around the closing of the Rabobank acquisition, and that is fully reflected in their cash flow planning. Beyond that, the goal is to bring Hepsiburada toward the kind of engagement metrics Kaspi achieves in Kazakhstan. And while all of this is happening, Kaspi has resumed its dividend. The proposed dividend is 850 tenge per share per quarter, which is 3,400 tenge annually. At the current exchange rate of around 477 tenge per dollar, that works out to roughly $7.12 per share per year. On a stock price of $76.4, that is a dividend yield of about 9.3%. And Lomtadze stated explicitly that this level is sustainable for the remainder of 2026, based on the business's current performance and cash generation. One more thing I want to flag, because it will all look scary if you pull up the company on a screener. Operating margin compressed from 75% in 2024 to 55.4% in 2025. Net margin from 41% to 26%. This looks like the business is deteriorating. It is not. This is the consolidation of Hepsiburada at low margins, dragging down a Kazakhstan business that is still printing the same kind of margin it always has. If you back out Turkey, the Kazakhstan business is as profitable as ever. So, to summarize the Kaspi situation, you have a dominant payments, e-commerce and fintech platform in a growing economy. You have a clearly capped, deliberately managed expansion into a much larger neighboring market. You have a CEO who has communicated openly about the path to profitability there. You have a 9% dividend that management has called sustainable. And the whole thing trades at around 7 times earnings. I have a position in Kaspi. The first part of the deep dive, which is around 40 pages, is on my Patreon. I am currently writing part 2 of my Kaspi analysis, and in the future I may be doing another longer video about Kaspi here on the channel. So, let us come back to where we started. The argument I hear over and over again is that AI has made markets so efficient that there is no point in stock picking anymore. That the only rational thing to do is buy the index and go home. We have briefly looked through 2 companies. One is a debt-free real estate operator with a portfolio worth almost twice its market cap, growing, paying out 7 to 8% dividend. The other is the dominant consumer financial platform in its home country, paying a 9% dividend, trading at around 7 times earnings with a temporary and clearly bounded headwind that the market has decided to treat as permanent. If markets were really efficient, neither of these prices would exist. The truth is that AI is making the most crowded parts of the markets more efficient, not less. Every analyst at every fund now has the same tools, reading the same filings on the companies, the same handful of US large caps that every fund on earth is forced to hold. That competition is real, and outperformance there is genuinely getting so much harder. But there is an entire universe of businesses outside that arena. Companies in markets that are too small, too foreign, too complicated, or too inflation distorted for the big institutional capital to bother with. AI has not changed the fact that a fund managing $50 billion cannot buy a $2 billion Turkish REIT in any size that matters. AI has not changed the fact that most analysts at most funds do not care about a Kazakh company despite trading on NASDAQ. The opportunity is still here. It has just moved to where most people are not willing to look. Outperformance, by definition, requires doing something different from the crowd. If you want to do what everybody else does, you get what everybody else gets. That has always been true, and AI has not changed that. If anything, AI has made it more true because it has concentrated the herd more tightly than ever in the same names. If you want to read my full work on Torunlar and on Kaspi, including the parts I did not have the time to cover here, both deep dives are on my Patreon. The link is in the description. Thank you for watching, and I will see you in the next one. Bye.